Okay, Facebook, we are live. First time this week, so looking forward to this one. This is one I've wanted to do for a little while because it's a question I get. There's probably 5 or 6 questions that I get regularly over and over again, and this is one of them, which is how do I make more money when I'm trading? So how can I make more money? How can I be more profitable? And the challenge with this question is when I've worked in different parts of the world and I've done training in Singapore, in South Africa, it doesn't matter where I go, America, Canada, even when I've got new people coming into Trader Support Club that I've never met, I'm just having an online discussion with them. When I ask them, how many of you want to make more money from trading, or how many of you want to make money from trading, nobody says no. In fact, you could probably ask that question to anyone in any realm, whether it's trading, property investing, any kind of business. Everybody wants to make more money. So the challenge with this is when you're looking at a chart, and if you're looking at one of these and you're sat there and you've placed a trade, invariably that trade is not going to be what we call a perfect trade, where you get in at the precise point and get out just as the market turns. So very often when you're trading, the market is going to be showing you what you could have traded. Let's say you focus on a setup on Euro US dollar, you trade that, but as a result you miss the setup on US dollar yen. Or let's say you're trading a strategy that is with the trend based, that week it's against the trend setups that work. So the challenge that you have when you're trading is very often you can be focused on one thing and the money or the potential money can be made somewhere else. So I remember when I was going over to Vegas, it was about 3 or 4 years ago, and there was a group of us, friends, some traders, some property investors, some just guys that ran businesses. And one of the guys there, one of the most wealthy and successful, one of the things he said on the flight on the way out is he said, Ali, you've always got to remember to be in the money. All right. Now, he didn't mean you've got to be in it to win it, but I asked him what he meant by that, and I'm going to talk about that at the end of the video because it's very, very prevalent to becoming a successful trader or making more money. So I think when it comes to how do you make more money, most traders make the biggest mistake at this point, and they simply try and trade more. And this is because the market is there, it's always there, there's potentially always an opportunity that you could have traded, and the benefit of hindsight can create this situation in a trader's mind where they're like, I'm just going to trade more. So the worst thing traders can do if they're trying to make more money is just simply and blanketly or with blinkers on, just go, I'm just going to trade more. I'm just going to keep trading more because the more I trade, the more money I'll make. And in fact, when I've coached traders, especially traders that have gone from that point where they are trading alongside a job or trading part-time, and they go full-time, there's this false assumption that a lot of them make. They say, well, I'm making X right now, I'm making 5, 6, 7, 10% per month on my account. When I go full-time, I'll have more time so I can make more money. And there isn't necessarily a direct correlation between the amount of time that you trade or the amount of time that you, or the amount of strategies or the amount of focus that you give trading and the amount of money you make. There isn't always a direct correlation. Now, yes, trading more is an option, but it isn't simple enough just to say, right, I'm just going to trade more. So it might be that you're swing trading and you now have more time. You could add day trading into what you do. So therefore you are trading more. But this is the key, that you have to be able and you have to make sure that if you're going to trade more, it's going to be profitable. Because the risk is you could have your swing trading that's profitable, you start day trading and you haven't had enough experience, you haven't done the work, you don't separate the two accounts, and as a result, the money you make from swing trading, you give it back because of the losses that you have from your day trading. So trading more is not the solution to simply making more money, but it is an option if you do it correctly. So again, this is one of the biggest mistakes people make. And very often, if they're trading more, it can be driven by fear. And this is another thing that I want to talk about. So another thing traders try and do is they say, okay, I'm going to try and run my trades for longer. So what I'm going to do is I'm going to hold on to my trades for longer, because if I'm in the trade for longer, I'll make more money. But very often, this is driven by fear. And we've all had these scenarios as traders where we've got a specific level that we want price to reach. Price comes up, gets really close, pulls back down. Gets really close again, pulls back down. And in your head, you're thinking, I just want this to get to my target. I just want it to reach my target. And then it reaches your target, you end up with the winner, you feel a sense of relief, and then what you get is price going past your target, past your target, past your target. And in that moment, you then start thinking, I wish I'd held it. If I'd held it, I'd have made more money. Now, that is with the benefit of hindsight. But what you should be doing in that scenario, very much like trading more. So both of these scenarios is where traders make the mistake to make more money. They trade more, they try and hold their trades for longer. But both of those can be the solution if they're focusing on the right thing. So to trade more, you need to make sure that what you're trading works and you can work it. If you're going to run your trades for longer, it's no good looking at one trade and simply going, should have held it for longer, and then the next trade that comes along, you hold that trade for longer. Because the risk is then, it reaches what would have been your old target, it goes up, you're holding it because you're doing that based on the previous trade, holding it, then that trade falls away, and it ends up going back down to a break even or down to a loss, and then you start thinking, should have got out of my old entry. So then what happens is, your brain's going through what we call a crazy eight, and you're not really making a strategic decision. So yes, holding trades for longer is an option, but you have to track the trades. The concept, and I was actually talking about this in our trading room last night, is that you have to record the maximum exit, be it a long trade, maximum exit being a short trade, on every single trade you place. Because the key, if you are going to run trades for longer to make more money, there must be the capacity to do that on a decent data sample. You can't simply just run a trade for longer because you want to make more money or because the previous trade ran on for longer. There must be the capacity on a decent data sample. Now that begs the question, what's a decent data sample? Well, that's something we can do in another video, but there has to be a significant data sample. Otherwise the risk is you try and make more money on one trade and you end up losing more. So really those two scenarios of holding trades for longer and trading more, for you to be successful at doing that so you make more money, it can't be a reactionary decision, it can't be a short-term decision, it has to be something that is planned and the capacity has to be there to do it. So another one that a lot of traders will do is they will just blanketly add more markets. And again, this can work, but it comes back to data and testing. It's very easy if your strategy works on, let's say you're a swing trader and your strategy works very well on major currency pairs and major cross pairs, and then you decide to add in other currency pairs that aren't as big, don't have as much liquidity, or you decide to do it on commodities and indices. But the behavior of those markets may be different to the behavior of the markets that are in your current setup. So as a result, what ends up happening is you end up adding markets in, but your performance doesn't go up. So again, it comes back to testing those markets before you bring them in. It might be that you bring those markets in and they have a little bit of a losing run. So short term you think, well, I'm not making any more money. I've added in an additional 10 markets, but I'm not making any more money. But if you've got the data for those markets, what that then means is you're aware that those markets are actually also going to have losing periods as well. So one of the big issues that traders have is they think this. They think, right, I'm going to add more markets, or the next one to make more money is I'm going to add another strategy. So essentially what happens to their trade frequency, so let's say over a period of a year their trade frequency was 100 trades in that year. Now their trade frequency has gone up to 200 trades. And they look at that scenario in a linear way. So they go, well, I had 100 trades making me 80% a year. I've now got 200 trades, so potentially I could double what I'm making. And that logic makes sense, but the trouble is you're looking at it from a linear perspective. What a trader doesn't tend to do is go, okay, on my first 100 trades, what were the drawdown periods that I had? So the losing periods, how long did they last? and what was the size. So let's say the drawdown period was 6%, worst case scenario, and that's a pretty good drawdown. Let's say it was 6%. What they then don't think about is if I'm going to add in another strategy, or I'm going to add in an additional 10 markets. Yes, the potential for reward is greater over a year, over 2 years, but so is the potential for the loss. Now, the trader might get lucky, and whilst the original strategies are hitting a losing period, the other strategies are winning. Or the additional markets that they brought in compensate for the others. So actually, there could be a period where a 6, 7, 8% drawdown is actually cancelled out. But the other can happen as well is that the additional markets could end up hitting a losing run the same time as the original markets, or the additional strategy that they bring in does the same thing. So actually what could happen is over that period of time, 1 year, 2 year, their return will be greater, but the periods of drawdown that they incur during that 2 years could be greater as well. So the challenge is the trader wants to make more money, but short term, because of random distribution, all of those trades that they're now trading, more trade frequency, means they're having a greater loser. And short term, they think, I'm not making any more money, so what's the point? So you have to look at the price you're going to pay, or the cost benefit over the cost over the short term for the benefit over the long term. So all of these scenarios that traders think up are opportunities to make more money, but invariably traders look at them either too short term, or they don't look at the data and they don't look at the capacity that those trades can make, or they don't look at the drawdowns or the negatives. Because if they're aware of those negatives, then they're much more equipped to deal with the short-term ups and downs that they're going to face. So this is a really, really important concept. Ultimately, if you're going to try and make more money, whether it's more strategies, and whether you're adding in an additional against the trend strategy to your current against the trend trade, or you're going to go and add in a with the trend strategy with your against the trend. So you're looking at different market scenarios, whether you're going to add in more markets, whether you're going to try and run your trades for longer, or lastly, you're going to try and effectively move your stops. So the same trade, you're able to reduce the size of your stop, so you increase your risk to reward. All of these scenarios have to be tested, and you need an awareness of the cost that you're going to incur. And this links back to what I was saying about my buddy when I was on that flight to Vegas. So his thing was, Ali, you've got to be in the money. Now, he wasn't a trader, he was a business owner. And when I asked him what he meant, what he essentially meant is you've got to have a willingness to understand every element of the money that you are earning and the potential cost benefits for adding something else in. And when I heard that, the light bulb went off. I went, that is exactly what it's like for trading. So you have to have a healthy fascination for the process. You can't simply just go, I want to make more money, so I'm going to trade more. I want to make more money, so I'm just going to add in more markets. That's too linear. You're not spending enough time getting into the consequences of doing that. So the traders that I know that are able to not only make money, but scale up, understand that doing that, there are going to be periods where it hits them a little bit harder. And they understand that having two strategies that bring you 200 trades a year instead of one that brings you 100 is going to have a cost to the longer term benefit. So I think if you're asking, how do I make more money in trading? Is you've got to look at these different variables. You don't necessarily have to do all of them at once. You might simply just try and run your trades for longer on your current strategy. But what a lot of traders will do is they'll throw the kitchen sink. They go, right, I'm going to run my trades for longer. I'm going to bring in 10 new markets. I'm going to bring in another strategy. And what they've done is completely negated those short-term costs to the longer-term benefit. So beware of your assumptions. And I would say, get somebody that you can feed back from. So whether it's a trading coach, whether it's somebody that's doing something similar to what you're doing or has been through that, because they will be able to help you highlight the costs, the short-term costs, to the longer-term benefits. Great stuff. That's all I got for today. I will be back with you again very soon. Take care.